webinar. I am Tan Chi Tat, investment analyst with Phillip Futures. Today's webinar will be about the recent supply outlook from OPEC producers, focusing on Nigeria, Iran, Libya, and Iraq. We'll see how the anticipation of output from these four countries will affect crude oil prices. Without further ado, we shall proceed on with today's webinar session. Disclaimer: the purpose of this presentation is for general information and education only. For investment advice, please approach our Phillip Futures representatives for an analysis of your risks and returns. This is today's content. We will first focus on the recent supply outlook from the OPEC producers. Next, we will move on to look at the technical analysis for both WTI and Brent crude oil. Last but not least, I will wrap up today's presentation with a conclusion. This chart shows the OPEC members' production for the month of September this year. Total OPEC production stood at about 31 million barrels for that month, with Saudi Arabia being the largest OPEC producer, with output accounting to almost one-third of OPEC's total production. We'll move on to look at Nigeria. Nigeria is the world's 12th largest oil-producing country, with proven oil reserves at 37.2 billion barrels as of end 2011. It has established an oil-producing target of 4 million barrels per day. And this is a monthly Nigeria oil-producing chart for year 2013. We can see a gradual recovery in oil production in the last few months. However, the production is still far from the 4 million barrels per day established target. Force majeure in this context refers to the inability to fulfill obligations in oil exports due to circumstances beyond the control of the parties. It estimated that Nigeria loses about 200,000 barrels a day, or 10% of production, with most going to international criminal gangs and sell it on world markets. So, what are the implications of oil theft? Oil theft leads to pipeline damage that is often severe, causing loss of production, pollution, and forcing companies to shut in production. In fact, upstream oil exploration activities fell to their lowest in a decade. This will result in overall reduction in production of bony light crude in Nigeria. This chart shows the estimated unplanned crude oil production disruptions among OPEC producers. Referring to the green bar, which denotes loss in oil production from Nigeria, we do see an aggravation in disruptions this year. This chart shows the incidences of pipeline vandalism in Nigeria, reflecting the severity in some of the years such as 2006, 2007, and 2011. So what needs to be done to raise production in Nigeria? Firstly, the government has to push for the passing of the Petroleum Industrial Bill, in short PIB. The Petroleum Industrial Bill is a bill targeted to reform the entire hydrocarbon sector. It includes contentious points such as the renegotiation of contracts with international oil companies, the changes in tax and royalty structures, and clauses to ensure that companies use or lose their assets. The ongoing debate has delayed investments in both the oil and natural gas sectors. The implementation of the Petroleum Industrial Bill could potentially iron out investment uncertainties and set a regulatory framework for the country's oil and gas industry. Also, more concerted efforts by all parties are required, including the government and communities in the restive Niger Delta, in order to overcome the ongoing oil crisis in the nation. Next, we'll move on to Iran. Iran is the world's 6th largest oil-producing country, with proven oil reserves at 154 billion barrels as of end of January 2013. This is monthly Iran oil producing chart for year 2013. Like Nigeria, we can see a gradual recovery in oil production in the last few months. Iran was accused of pursuing non-civilian objectives in its nuclear energy program, which resulted in sanctions enacted by the US and EU in 2011 and 2012. In 2012, Iran saw unprecedented drops in its oil exports as sanctions by the US and EU were tightened, targeting Iranian oil export revenues. The repercussions were serious as a series of sanctions had led to cancellation of new projects by a number of foreign companies, while also affecting existing projects. While under sanctions, China is the biggest supporter for Iranian oil. In fact, China had imported 24% more Iranian crude oil in September as compared to a year ago. And lately, we see some light in the lifting of sanctions from Iran. The recent nuclear negotiations, which is held in Geneva between Iran and the six powers, namely the US, Britain, France, Germany, Russia and China, show that Iran is serious and candid in the talks. It suggested that Iran is ready to scale back sensitive activities in exchange for sanctions relief. Markets will get more directions on the developments in the forthcoming follow-up talks between the six powers and Iran held in Geneva on November 7 to 8. The lifting of sanctions and the influx of Iran oil into the markets are likely to ease on the current high crude oil prices. Next, we'll move on to Libya. Libya is the holder of Africa's largest proved oil reserves and an important contributor to the global supply of high-quality, light sweet crude oil besides the WTI and Brent crude. Libya typically exports most of its crude oil to European countries, with Italy being the leading recipient. And according to EIA estimates, Libya's current effective production capacity is slightly below 1.6 million barrels per day. Effective production capacity is defined as the amount of production that could come back to markets within a year. It takes into account permanent or prolonged production loss due to the degradation of shut-in oil fields and damages to operational components that would take longer than a year to repair, which is dependent on the financial, security and political situation. This means that Libya has the potential to reach the 1.6 million barrels per day target within a year's time. This is a monthly Libya oil producing chart for year 2013. We can see a rapid decline in oil production since June. This chart gives a good overview on Libya oil events. We see that oil production plunged during the civil war in 2011 with the toppling of the Colonel Gaddafi regime and the gradual consolidation of control over most parts of the country by the rebels. The zero level here does not mean no production, but rather no data is being collected. Production rebounded rapidly months later following the cessation of most hostilities by the autumn of that year. Oil production remained above 1 million barrels per day after the civil war, but is subjected to fluctuations due to occasional labor-related protests and power supply problems at oil fields. However, oil productions were once again crippled in mid-2013 due to protest escalation. The disruption was so serious that oil production shrunk to just over 10% in capacity, or less than 200,000 barrels per day, in early September this year. Since mid-September, we see a gradual resumption in Libya output as Western oil fields in Libya restarted production. Current output stands at approximately 600,000 barrels per day. Going forward, we will expect production to ramp up at a gradual pace due to uncertainties in Libya. Last but not least, let us look at Iraq. Iraq is the world's 8th largest oil producing country, holding the 5th largest oil reserves in the world. Proven oil reserves stands at 141 barrels as of January 2013. Majority of Iraq's oil is exported to the US and refineries in Asia. Crude oil production averaged at 3 million barrels per day in 2012. This is the monthly Iraq oil producing chart for year 2013. Crude oil production has stayed relatively constant at 3.2 million barrels per day for most of the months. However, in September, production soared to 3.3 million barrels per day, the highest among all the months this year. Iraq has been pushing for the passage of the Hydrocarbon Law, which would provide a legal framework for investment in the hydrocarbon sector. Furthermore, the government had committed themselves to long-term contracts with international oil companies to raise Iraqi production capacity to almost 12 million barrels per day by 2017. However, contracts were later being renegotiated to more modest level to 9.5 million barrels per day by 2017. Despite so, the revised targets are still deemed ambitious and overly optimistic due to delays in developing the nation's energy infrastructure. Going forward, Iraq is likely to face more challenges in a bid to raise output. First of all, refining and export infrastructure are severely constrained, with bottlenecks preventing more crude oil processing. Political disputes between the central government in Baghdad and the Kurdistan regional government has slowed the progress of increasing pipeline capacity, which limits the access to export infrastructure in the north. Iraq is also involved in conflicts over shared oil fields with neighboring countries such as Kuwait and Iran. We will expect oil production in Iraq to increase over time, supported by improvements on export and refining infrastructures by international oil companies. To summarize, situations in Nigeria remain uncertain as oil theft incidences are still ongoing. Nonetheless, we believe that output will increase gradually as shown in the last few months. Situations are likely to improve with the passing of the Petroleum Industrial Bill, which put the regulatory framework in place. For Iran, we expect to see a potential breakthrough in the nuclear talks. The lifting of sanctions by the US and EU will result in the influx of Iranian oil supplies in world markets, easing on the current high oil prices. Labor protests in Libya are still ongoing. Situations are still uncertain. However, we do see an easing in the situations with the gradual recovery in Libya oil supplies. We are optimistic that Libya oil would eventually resume production as at previous high levels, since EIA believe that Libya is likely to resume oil production to 1.6 million barrels per day in 1 year's time. Last but not least, Iraq's oil production is limited by refining and export infrastructure constraints. Nonetheless, with the Iraqi government setting ambitious oil production targets and the signings with international oil companies, we believe that infrastructure developments are forthcoming. Iraq oil output is likely to increase as a result. Next, we'll move on to the technical analysis for crude oil. This is the 1-year daily price chart for WTI crude. We do see that prices broke below the bullish trend line, a possible bearish sign. The ADX below shows a figure above 20, which signals trending. As such, we may expect the build-up on downward momentum to take place. The current intermediate support is at 92.5, while immediate resistance is at 102.5. If prices were to break below the 92.5 immediate support level, we can expect prices to test the next support level at 90. This is the same WTI 1-year price chart using different indicators. We do see a gradual divergence between the moving averages. The short-term green moving averages stay below the long-term red moving averages, suggesting downtrend to remain intact. The MACD is well below the zero level line in the bearish region and below the red signal line. This may suggest increasing downtrend momentum. Moving on, we have the 1-year daily price chart for Brent Crude. We see a similar pattern occurring here as displayed in the WTI Crude price chart shown earlier on. Once again, we see that prices broke below the bullish trend line, a possible bearish sign. However, the ADX below shows a figure below 20, which signals consolidation. As such, we may expect prices to undergo a period of correction between it drops at a gradual pace. The current immediate support is at 107, while immediate resistance is at 112.5. If prices were to break below the 107 immediate support level, we can expect prices to test the next support level at 100. This is the same Brent 1-year price chart using different indicators. We do see that the moving averages are intertwined, suggesting a possible consolidation period. The short-term green moving averages attempt to pull below the long-term red moving averages, which may denote early signs of a downtrend. The MACD has just slipped below the zero level and the red signal line, which further reiterates the early signs of a downtrend. To conclude, we believe that output from the 4 OPEC members, namely Nigeria, Libya, Iraq and Iran, are likely to increase in the next few months. This will result in the weighing down on crude oil prices. The fundamental analysis is further supported by the bearish signs displayed in the subsequent technical analysis. As such, we are bearish on the commodity. We have now come to the end of our webinar on crude oil futures. For more information on the risks and returns of trading crude oil futures contract, please approach any of our Phillip Futures representatives. Thank you, and please stay tuned for more market updates. I'm Tan Chi Tat, Investment Analyst with Phillip Futures.